So David, the FRC have released their proposed amendments to FRS 102. Can you give us a bit more detail about the amendments?
Absolutely, thanks Kelly. So the proposed amendments aim to update FRS 102 by incorporating some of the key principles from IFRS, specifically in relation to revenue recognition and leases. So while these proposals have not yet been finalised, we do expect that these will be effective for accounting periods beginning on or after 1 January 2025.
So would it be fair to say that the amendments in respect of revenue recognition and leases will have the most impact?
That's exactly it. These are the areas that clients should be more focused on. So in summary, in terms of revenue recognition, we'll see the introduction of a new five-step model, similar to the current principles under IFRS 15. And for operating leases, they'll also see the introduction of a model that brings in those key principles under IFRS 16 as well. So in terms of revenue recognition, those most impacted will be those clients that have complex revenue recognition contracts and arrangements in place with their customers. So certain sectors will likely be more impacted than others. In terms of operating leases, we do expect this to be a significant change, fundamentally changing how clients account for operating leases. So at the moment, these would be expensed under FRS 102, but under the new proposed model, these will come on balance sheet, being recognised in a right of use asset and in a corresponding lease liability. So this is the changes we would have seen in IFRS back in 2019, when IFRS 16 was brought in, and we both recall probably some of the practical challenges the clients faced when that happened.
We can indeed. It was a huge, a really costly undertaking for many clients if you take into account the data collection, the resourcing, the system change. That's not to mention the impact that IFRS 16 would have had on key financial metrics. So take your EBITDA as an example. Under the new model, your lease expense is replaced with a depreciation and an interest charge. Both of those will fall below the line, so boosting a client's EBITDA. Whereas on the other hand, recognising those lease liabilities on balance sheet will ultimately lead to an increase in net debt. So those are really quite significant points and will be of particular interest to those clients with the likes of banking covenants or perhaps long-term incentive plans linked to either of those metrics. So a huge shift indeed, especially if we think about our smaller privately owned clients with no real experience of IFRS or even US GAAP reporting.
Yeah, that's right. And look, while these proposals should hopefully enhance the quality and comparability of financial statements, they have been developed to hopefully be proportionate in terms of size and complexities of those adopting it. So if you do consider these changes in revenue recognition and leases, both models do include certain simplifications in specific scenarios where when compared to their full IFRS equivalent. So hopefully that's somewhat helpful in that regard.
Yeah, that's really helpful, and it should ease the transition burden in due course. Is there anything else that we need to be mindful of or aware of?
Yeah, so there has been further enhancements and clarifications in the proposals, but likely a number of which won't be material for entities. One of the key areas that a lot of clients will be happy to hear is that the expected credit loss model under IFRS 9, those principles are not currently being brought in these proposed changes. So the FRC has decided to defer that, which is maybe good news to many.
Great news indeed. Would we say it's too early for our clients to start preparing for the transition?
No, not at all. When it comes to transition projects, these can often take time and often give rise to a number of complexities. So what we have seen in the past is clients want certainty in terms of the impact on their EBITDA and other key metrics, but also then want to be in a position to include these in their forecast going forward. So we do see clients getting straight into this at the moment, even though the proposals have not been finalised.
Thanks, David. That's been really insightful, and hopefully clients find it helpful. Next time, we'll take a deeper dive into the new revenue model. If you've any questions in the meantime, please feel free to reach out to David, myself, or another member of the accounting advisory team.